Well, as we continue our look back at 2021 and looking ahead to next year, 2022, a pleasure to be joined once again by Wharton Finance Professor Jeremy Siegel. Jeremy, great to see you. Hope you're doing well.
I am doing well. Thank you, Dan.
Give us your overview on how you thought 2021 went from a market perspective.
Well, early on in 2021, I saw the burst of the money supply that was produced by the Federal Reserve, and that really clued me in on what was going to happen. I had never seen such a strong provision of liquidity, and I knew it would first go into the markets because spending was repressed. But I, had predicted that we were going to have substantial inflation in 2021, and so what has happened has not surprised me.
Are we past the point where we consider it to be transitory?
Oh, absolutely. It was never transitory. I mean, in the sense that it's only going to be a few months. In fact, I have been saying for over 6 months that I think the cumulative amount of inflation that we're going to have over the next 3 or 4 years is going to be 20 to 25%. Now, I don't mean that in 1 year, but I mean, if we could have 7, 7, 7, 5, 5, 5, 5, it's impossible to know how it's going to exactly be distributed. But when we come out of this, I think the price level of goods and services is going to be about 25% higher.
So what do you think that's going to mean for the path of the Fed? And obviously, the fact that it looks like that you're going to have Jerome Powell running the Federal Reserve again for a second term. You'll have a vice chair with Lael Brainard working with him on this. What's that going to mean for the path of the Fed in 2022?
Well, I think the Fed is way behind the curve. And I've been saying this for quite a while. They should have stopped the tapering and should have started raising interest rates by now. I think they're going to have to make a pivot, and that perhaps is going to come at the December meeting for a faster taper and a sooner increase in interest rates. The Fed must get more aggressive.
Will we see then, incremental increases in rates, maybe by 25 basis points here as we move through the early parts of 2022?
We may even have to jump 50 basis points, because if we have inflation rising at 6-7%, baby steps is not going to do it. I think we have to probably raise the short rate of 4 or 5%, and we would have to do that within a couple of years, because right now, as long as the interest rate stays so far below the rate of inflation, it just encourages people to borrow and buy goods.
Let me get your thoughts on the move by the Biden administration to once again nominate Jerome Powell for Fed chair.
Yeah. I mean, I supported Powell. I thought actually it was a slam dunk. I think it's a win-win for Biden. If inflation is out of control, he can blame a Republican. If it's if he gets it under control, he can say it's my choice. If he picks Lael Brainard, then he owns it 100%, and inflation continues. Then he has to take even more heat. Powell has the confidence of Wall Street. There is continuity. There's a huge historical record of Democrats taking Republicans as head of chair of the Federal Reserve. And let's face it, I have called Jay Powell the most dovish chairman that I know. And so, he is not far from, what the Democrats generally support in terms of stimulating the economy.
So it was not a surprise to you that Lael Brainard did not get the...
No, not at all. I was not at all surprised. I was always saying, I even told people that it was a slam dunk, that of course it became, as the delay came, it looked a little closer, but all the arguments seemed to be to keep Powell in, given that Wall Street supported him, and that he has somewhat of a foil in terms of what might happen at the Fed.
It's going to be an interesting next year, I think, as well, Professor Siegel, from the perspective of, we're still dealing with labor issues here in this country. You have an economy which is building itself back, but still is not where it was in 2019. And I think from a policy perspective, it becomes that much more important for the Fed and for the Biden administration to really get their ducks in a row here going into 2022 to really make the biggest push that they can.
Yeah, you're absolutely. And by the way, the economy is not going to come back to 2019. We've had a permanent shock to the economy and to the labor supply that's only partially going to be rectified. So the world has changed. And we also know that Biden has 3 or 4 more picks for Fed chair, not for the chair, for Fed positions on the board. Yeah. And so he still has a lot of opportunity. I think that that's another reason why he picked Powell. I mean, he has a number of hand-picked people. He knows he can get Powell through the Senate. And so in this case, they might cut him a little slack in the 3 nominations.
I remember talking with you a while back when we were talking about the potential of Dow 30,000. So here we are at Dow 35,000, and
more than that, even, right?
Yeah, and it's been about a 6% bump this year from where we were at the beginning of the year. Are you optimistic that we can have even half that coming up next year?
Well, I don't think we're going to have it. This has been a great year, over 20% on the S&P. I mean, I think it's going to be more modest. I think there's going to be some headwinds when the Fed pivots. But basically, stocks are real assets, and you want to hold real assets when there is inflation. So, I'm saying I could see the S&P hitting 5,000 in toward the end of next year. Much more modest gain than this year, but still a positive gain. And the Dow tacking on several thousand more points. I'm not saying it's going to hit 40,000.
I was waiting for you to say whether or not you're going to have a hat that says Dow 40K on it.
It'll eventually happen. Dow 35,000 finally happened for Kevin Hassett and James Glassman. The book was written in 2000, took 21 years. Finally happened. But the long-term trends are always are favorable for the market still. And I do not regard the market, I don't regard it as cheap, but I do not regard the market as wildly overvalued. I'm not talking about every stock, but many, the bulk of the market in the S&P 500, I think, is quite reasonably priced given the economic circumstances.
So what are the couple of things you are most watchful of, thinking about policy, thinking about the markets, this entire mix? What are you most focused on as we go into 2022? What is really keying your interest?
Well, I look at the money supply. I mean, my history has been monetary theory and policy, and it's been out of control. And it comes out, it came out yesterday, actually. It comes out on the 4th Tuesday of every month. And although it's slowed a little bit, it is still going up at double-digit rates. That's not consistent with 2 or even 3% rates of inflation. We must get liquidity under control in the economy. The only way really to do that is the Federal Reserve, first to stop the taper, and secondly to raise rates. That's what I'm looking at. If they can do that and stop the growth of this liquidity, we'll finally get that inflation under control.
How much then are you also focused on some of these issues around labor that we've been seeing?
Well, I think the labor, there's 2 labor markets. Those that are active and moving around are getting 10, 15, 20% raises. Yeah. Who's losing now are the people who are, white collar workers that got their 3% raise in January, and now we have inflation of over 6%. They're losing 3%. They're not going to be so quiet next January. They're not going to be satisfied with 3% next January. You need 6% to stay even with inflation. So I think you're going to be seeing some big labor bumps in the coming months.
Professor, as always, it's great to talk with you, and we look forward to talking to you throughout the course of 2022.
Thank you, Dan.
All the best. Wharton Finance Professor Jeremy Siegel.